here in Vancouver for VRIC 2019, and joining me now is Warren Stanyer. Warren, tell me a little bit about your company. First of all, what's it called, and where you're trading, plus your symbol.
Okay, that's good. Those are three direct questions. ALX Uranium Corp, and we trade on the TSXV Venture Exchange, and our symbol is AL, Alpha Lima.
But you are specialized, you're focused on uranium.
We are focused on uranium, yes.
Why uranium? What is it about uranium right now that makes you say the market is right for uranium?
Uranium is still worth a lot of money. So if you find a 10% uranium deposit, that's 220 pounds per ton. And even at $30 a ton, that's over $6,000 per ton US. So name me another commodity that's that lucrative. Yes, you have to produce it for a low amount of money, and probably the productions are $40 to $50 for an underground mine in the Athabasca where we look.
Right.
But still, these deposits are the most lucrative and valuable deposits in the world.
And the Athabasca region really is quite an extraordinary geographical zone for uranium, as I understand.
It absolutely is. It's just very unique. When I first, in a gold company, when we took a look at uranium in 1997, the first thing that we saw was the value, the grade, all these things that what makes it a little bit harder to find. They're not big, large targets. They're little skinny targets, but they're incredibly high grade. And the Athabasca has a grade that's probably 10 times that of the world standard, so to speak, the world average.
10 times?
At least 10 times, yeah. I mean, I could pull numbers out of a hat here or there, or different hats, but generally speaking, your grade in the Athabasca is at least 1% at an operating deposit, 1 to 5, and sometimes as high as 20, whereas your grade in Namibia or Australia might be 0.03%. Or 0.5 at most. So 5,000.
And you can still have a commercially viable site in those jurisdictions?
You can if it's
so
shallow.
1%, it's a scale of magnitude that is considerably larger.
And that's right, and it's all about the depth to the ore zone and what it costs to get it out of the ground. But I mean, they made money at McArthur River for many years at 500 to 600 meters depth at over 20% grade. So 20%, that's 440 pounds of uranium times 30, that's $13,000 US per ton. When uranium went to $50, $60, $70, $80, and often the producers forward sell at a higher price.
Yes.
So the spot price is just a basic indicator.
And so right now, you're in that exploration stage and you're waiting until you have enough data to be able to then say, we're going to move forward. But then you still need the market factors to line up.
You do. I mean, if uranium crashed again down to $20, I think a lot of interest in the sector would dissipate, but it's not going that way. And what people are starting to notice, funds from New York were here at this show. I talked with this one gentleman, and it was gratifying to hear his take on the market, how he's so optimistic about it, that there's a shell game going on with the pricing and the supply-demand curves and things like that. But we know how to find uranium because everyone in our team has done it.
Thank you very much.